Hey, what's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my new series on the channel called Ask Ale, where I basically answer a few of your guys' questions. I give kind of quick, short responses to them, and it's a lot of fun. Today is going to actually be episode number 2, and if you guys ever want your questions to be featured in one of these videos, all you got to do is drop a comment down below in this video or any other video, and it might get selected. But with that said, got a few questions to run through today. It's going to be a lot of fun, so let's jump straight into it. And kicking things off with question number 1, that's going to be from MTC New, who asks, how much cash do you typically hold percentage wise? Okay, so let me just quickly kind of clarify something here. I'm answering this question in relation to my stock market portfolio. Of course, I have cash savings outside of stocks. So I have savings, say to maybe buy a house or for emergencies or things like that. That is separate from my stock market portfolio. But within my stock market portfolio, there is a portion of it that will be cash, and it will always be there. I'm always going to have that cash portion of my stock market portfolio that I keep there in case I ever see a big opportunity in the market and I want to go in heavier, then I have that cash to be able to do that. It changes kind of gradually and slowly. Sometimes it'll go up or it'll go down, and it depends on how the stock market is doing, if it's overvalued, if there are just no good deals in the stock market, or if things are really cheap, maybe we just had a correction or a crash, then that cash portion will fluctuate up or down. And I'll give you some percentages really quick, but one way that I kind of manipulate that cash portion, because people might think, well, you're just going to sell stocks and put that money towards that cash position if you want to grow it, or, you'll take money out of it and buy stocks and you'll manipulate it that way. It's actually not the most common way that I manipulate the cash portion of my portfolio. Instead, what I do is I have my income from my regular work. So I'm a college professor, I also do YouTube, and I have my income every single month. And from that income, I take a portion of it, and that goes towards my stock market portfolio. Now, when stock prices are expensive and I don't see a lot of good deals, more of that income will go towards the cash portion if I don't see a lot of good deals. If I do see a lot of good deals, then more of that portion will go towards buying stocks and less will go towards the cash portion of my portfolio. So that's how I manipulate it, slowly, gradually, over time, with the funds that come in every month that I allocate to either stocks or to the cash portion of my portfolio. I do also obviously make changes to stocks, and sometimes I'll sell and things like that, but this is usually the most common way that I try to manipulate that cash portion. So in terms of percentages, when stocks are really cheap in the market, so if we just had like a correction or a crash, then the cash portion of my portfolio will go down to around, could get as low as like 10% or even less, could even get into the single digits, especially if we just had a big correction or crash and there's a ton of good deals out there and I want to go out and buy really heavy, then I'll not only go out and buy heavy with my monthly income that goes towards stocks, but I'll also tap into my cash portion and I'll take money out of that and I'll throw it into stocks because there's just so many good deals. I got to jump on them. I got to buy heavy. So my cash portion will shrink and it'll get down to around 10% or even less, maybe the single digits. Last year we had the recession, we had that sharp crash. Yeah, I got to around 10% of cash there because I was buying pretty heavy on some stocks that I really liked. Now, when things are kind of normal, there's, kind of decent prices out there, nothing too crazy, no extremes on either side, then maybe the cash portion of my portfolio will typically sit at around 20 to 30%. So maybe like a quarter of my portfolio will be cash. Again, I don't necessarily need a huge portion of cash because I have my monthly income that's coming in that I allocate to buying stocks. So I'll tap into that first. But if I run out of that, and I still see such good deals in the market, then I'll tap into the cash and I'll start taking some cash out of there too. So it kind of slowly changes, but yeah, I would say when things are kind of normalized, yeah, maybe I'm around a quarter of my portfolio is probably in cash, something like that. And that's because I just want to make sure I still have some cash reserves there in case anything kind of big happens. A correction or crash can happen at any moment. And sometimes an individual stock can have some kind of catastrophic event within their own business and the stock will crash. And you want to be able to jump in and buy the stock at those prices. You want to make sure you have some cash. So I always have cash in my portfolio ready to go. Now, when stock prices are really expensive, which is what I feel we're in right now. We're kind of like, we're in this bubble, I feel right now. Definitely feel like a correction is headed our way, if not a crash at some point, but I definitely think a healthy correction is really needed right now in the market. And so prices are pretty high, then the cash portion will grow in my portfolio because my monthly income that I allocate, a lot of that will actually just go to my cash portion. If I don't see a lot of good deals, I won't buy stocks. If I don't see very good deals out there, okay, then I'll just put more of my monthly income into that cash portion. I'll still put some into stocks and I'll still buy stocks wherever I think there's opportunities. And there's always opportunities. Even in this market where I feel everything is expensive, there's still lots of opportunities actually, in my opinion. I've found some stocks that I do really like. So I'll still buy some stocks, but I'll do it less and I'll put more of that monthly income into my cash portion, and it can grow. It can get up to around 40%. That's not where I'm at right now. I would say right now I'm probably at around 30%. Last time I checked, I think it was a little above 30%. But if we continue on this trajectory, we do not have a correction or crash, and the bubble keeps growing that I feel we're in right now in relation to the economy. I think the economy is very weak. I think stock valuations are way too high in comparison to that. We keep going in this trajectory, then yeah, my cash portion will probably get up to 40%, could even get to half of my portfolio, if things really keep going this way and we never see any kind of correction or something to kind of balance it out. But so yeah, right now it's a little high. It's around 30% or more. It's a little high, but I'm still out there. I'm still buying stocks. And anyway, yeah, that's kind of how I feel. There's no reason to overthink all of this, by the way. It's not like any of these are definitive kind of boundaries or limits that I have to follow. It fluctuates and it changes gradually, slowly over time. And yeah, this is just kind of in the general sense how I treat it. Okay, moving on to question number 2. This one is going to come from Kenzie Chan, who asks, good strategy that you start with one bet and then double, triple, or quadruple your position. So what happens when you made your first bet and the stock jumps up, say 10% very quickly? Then I guess you just stop and you're not going to buy anymore until a better chance comes along. Is this what you do? So let me just quickly explain this question. This question is referencing the last Ask Ale video where I talked about my investing strategy. And in that video, I talked about how I like to buy stocks when they're going down. And so because of that, sometimes I'll buy a stock and then it continues to drop. So I'll buy a stock and I'll buy a very small portion of it so that when it continues to drop, I can easily double my position, triple my position, quadruple my position. And it's very easy for me to lower my cost basis because I went in so light initially. So this question is asking, well, what happens if the opposite happens? What happens if the stock actually jumps up like 10% or something? Will you feel like you missed the boat, and will you just kind of sit back and wait for maybe for another opportunity for it to dip again? Or what do you do from there? Okay, so there's a few different ways we could address this question, but I think kind of the most obvious thing to just get out of the way first is that if the stock jumps up quickly by whatever amount because of a good reason, so maybe the company announced a new product, or maybe their financials are improving, maybe they just announced an earnings report and it looks like everything is just like doing way better than we all expected, then maybe there's a good reason for the stock to jump up by that percentage. So if that's the case, I have no problem buying the stock at a little bit of a premium if it's worth that premium. So I'll still buy it if it goes up, but because I am the type of investor who likes to buy stocks when they're going down, I'll just buy more aggressively and more frequently when a stock is going down rather than when it's going up. So if the stock suddenly shoots up, I'm still willing to buy it, but it'll probably be a much smaller amount and it'll be slower. And if I don't feel like the stock jumping up was justified, if I feel like it was just based on hype or whatever reason, something that is not really fundamental to their business, maybe it got announced that some big investor is investing in the stock and so everybody floods into it, or there's like something happens on Reddit and the Reddit people jump in and they shoot it up or something. If I don't feel like the company fundamentally improved and it's not worth the stock price going up, then I'll just sit back and wait. I'm not going to mess with that. I'll probably just sit back and wait. And if it climbs too much, too fast, I'll even consider selling, even though I am a long-term investor. But sometimes you get some really quick profits that you could take off the table where it just makes sense to sell some of that stock. Maybe I'll trim it a little bit. So there's a few different ways we could look at this, but just to kind of summarize here, I'm still willing to buy stock even if it goes up. It's just that I buy much more aggressively and heavier if the stock price is going down. That's all. All right, guys, moving on to question number 3. We've got Dwizzle, who says, Yo, Ale, this series is going to be a hit, bro. My investment strategy is very similar. Buy and hold good companies, especially when the stock price is falling. I'm definitely a buy the dip type of investor, BTD. But one downside is you can find yourself on the sidelines a lot, especially in bull or stagnant markets. One suggestion is to have a BTD portfolio, a buy the dip portfolio, and another portfolio for buying on a schedule, weekly, monthly, or quarterly. Anyway, good series, bro. Keep it up. Okay, thank you, by the way, for the comment. So this is obviously in reference to the last video, and it's kind of similar to the last question. So when you're a buy the dip type of investor, you're someone who likes to buy good companies when they're actually going down. Sometimes you may not have all the opportunities out there. And it's very important to be the type of investor where you have time in the market rather than you're trying to time the market, right? You don't want to time the market. You want to have time in the market, because over the long term, stock market goes up. And then you want to buy heavier on dips, corrections, and crashes. But you want to have more money in the stock market so that over the long term, you can benefit from it, and you want to keep compounding that and growing that over time. So when you're a buy the dip type of investor, you may not have as many opportunities to be buying stocks and adding more money into the stock market. So this person recommend, and by the way, it's a great recommendation, and it's to have 2 separate portfolios. One where you stick to a certain strategy, and another where you're a little bit kind of looser with it, or you make some adjustments to it so that you can make sure that you put more money into the market. So in that case, you would have a set schedule where you buy a certain amount. And so you have the 2 kind of separate portfolios where you stick to those 2 different strategies, and it's easy to organize because you have them separate. Personally, I don't like schedules because I actively look at stocks. I actively manage my portfolio. So I like to buy stocks exactly when I feel comfortable buying stocks. However, I really like the strategy. I'm just going to make one modification to it, and it's this. What I do is I even have separate brokers. So I have Robinhood, I have E-Trade, and I have M1 Finance. When I own a certain stock and it has gone up by a huge amount, and I no longer feel motivated or comfortable buying a lot more at those higher prices, but I still love the company and I would actually like to have more money in that company, then I will separate it into a different portfolio or a different account. So let me give you an example. I own Tesla stock and Microsoft stock, my 2 largest stocks in my entire portfolio. Both of them are up by a gigantic amount. If you look at my Tesla position, I'm up like 1,500% on my Tesla position. So naturally, I'm not going to be that motivated to buy more Tesla stock because I am a buy the dip type of investor. I like to buy stocks when they're going down, not when they're up 1,500%. However, I still really love Tesla and I really love Microsoft, and I would love to have more money in those companies. And there's times where they have little dips. They don't have big dips, and it's not dips big enough to see my giant position go down a huge amount. But they'll have little dips, and sometimes I want to buy on those little dips. I want to be a little bit looser with my strategy, and I want to be able to kind of make those changes. So what I'll do is I'll keep my big position in one portfolio. It's set there, it's safe, it's my largest position. It really has a lot of influence and control over my overall stock portfolio. I'll keep that in one account, and then in a separate account, I'll go in, so maybe that's with E-Trade or something, and then I'll go in with Robinhood, and I'll buy a little bit of Tesla stock. So I'll buy a little bit, a small amount, and then if it kind of goes down, I can buy some more, or if it, but I can be looser with it, and I can make little changes to it, and because it's a smaller amount, it's not going to damage my overall portfolio that much if I make a wrong move on it. So the reason I like doing that is because I'm able to stick to my investing strategy and principles and have my big positions that are doing really well long term, but I can still play around in the short term, still be a little speculative, and there's nothing wrong with that as long as you do it within reason and you stick to a good kind of strategy like this. So I hope I explained that in an easy to understand way, but the point is, it can be nice to have separate portfolios where you can stick to your kind of core investing principles in one, and then you can maybe be a little bit looser with another one and still kind of play around. And I've had a ton of success with that. And even in my other accounts where I've bought, little dips on Tesla and Microsoft, those stocks have gone up a huge amount too. So I've made lots of profits on those too. So I think it's a good strategy that works. Having separate accounts and stuff. I think it can all be beneficial as long as you manage it correctly and stay on top of it. All right, guys, moving on to question number 4. Toes in Air asks, Ale, since you're a long-term investor, my question is, when do you actually sell your stocks and how do you make that decision? Thanks, I love your videos. Okay, thank you for the nice comment. So it's a great question. I'm going to keep this short and to the point. As a long-term investor, when do I sell stocks? Okay, so let's just establish a couple things really quick. Long-term investors, we generally think of them as people who own stocks, we'll say around 5 to 10 years on average. That's kind of an average kind of holding period for long-term investors. But I modify that a little bit. I like to think way longer than that. When I buy my stocks, I like to think that I'm going to own them forever. And I'm pretty sure Warren Buffett has said similar things, that when he buys a stock, he kind of imagines himself being owner of that company, and he never really buys it with the intention of selling it. And I'm the same way. When I buy a stock, I don't ever think about when I'm going to sell the stock. I always just think I'm going to pretty much own it into retirement. However, that's not very realistic. We know that there are times to sell stocks, and I do sell stocks on occasion, and there's a few different reasons why I might sell a stock. One scenario could be that maybe I need to adjust my portfolio a little bit. Maybe a certain stock has become too big and too influential over my overall portfolio. And maybe it's kind of a riskier company, but the stock shot up by such a huge amount that it's now become a really big portion of my portfolio. And as a kind of fundamental investor, maybe I just don't feel comfortable with such a speculative stock having such great influence over my portfolio. And it's already up by such a huge amount, I'll probably trim it. So that's what I actually do a lot of the time. I trim positions, but I don't, it's very rare that I just completely sell out of a position, although it has happened. There are times where I have invested in a company and, maybe over time, management just proved to be doing a horrible job. That happened to me actually with like 2U, for example. It's a stock I don't like to think about, but it's a stock that it was a spec stock. I kind of gambled on it. Management just did a really bad job of communicating certain things with investors. I didn't like the way they were running the company, and I haven't even looked back into 2U, but maybe they're doing great now. I don't know. I kind of just lost interest when I lost faith in management. So sometimes that happens. Maybe I lose faith in management. Maybe the product just becomes worse over time. Maybe the company is not innovative enough. Certain things can happen where I just lose faith in the company and I lose that long-term vision. As long as I can see that long-term runway for the company and their business, and I see that potential, and I know that management is going to execute, I'll still buy the stock, I'll own the stock, and I'll own it very long-term into retirement or whatever. But when things change, sometimes I will sell out of that stock. So there isn't like a set time frame, right? So if this person is asking me like, oh, do you sell after 2 years, 3 years, or do you sell after your stock has gone up like 100%, 200%? I don't really pay attention to those things, to be honest. It's more so if I lose faith in the company, if I lose the long-term vision, and the valuation, I would say, is important. Sometimes the stock can just get so crazy expensive where the valuation makes no sense. And I think in those scenarios, it can be a good idea to trim some of that position. Take some of those profits off the table, and hey, it's not a big deal. You take that money, you put it into another stock that you think is at a great value. It's not like you're taking that money out and you're going to go spend it at McDonald's or something ridiculous, right? Money that comes out of stocks in my portfolio stays in my portfolio. It does not come out and gets wasted on something dumb, right? It gets reinvested. So there's nothing wrong with taking profits. As a long-term investor, nothing wrong with that. But typically I try to hold very long-term. And I would say, if you're asking me like, okay, but when are you really just going to sell out of everything? I don't know, maybe when I'm like retired. Okay, so maybe I retire at some point and I really just don't want to deal with stocks anymore, and I just want to have the money and I just want to live the rest of my life happy and just kind of comfortably, then maybe I'll sell out of everything. But that, I can't even envision that right now. I feel very young, and I still got a long runway to go here. So anyway, I hope that kind of addressed the question, but typically try to hold extremely long term, and I try not to think so much about when I'm going to sell. I try to think very long term. All right, guys, now let's finish up the episode with just a few different stocks. I'll give a quick opinion on them. I think I'm going to do this for every episode going forward. Towards the end of the episode, I'll just kind of give my quick opinion on a couple different stocks that you guys want me to share it on. So coming in here at question number 5, we've got Rafaela Rodriguez, who says, "Hi, Ale. what do you think of BlackRock, ticker symbol BLK, Chewy, which is another stock, and Alphabet, which is Google? Also says, keep up the good work. So thank you for the nice comment. Okay, I'll give my opinion on these 3 quick stocks and then we'll finish up the video. So we're looking at BlackRock. You guys might have heard of them. They've been kind of shady. They're especially lately, there's been some news about them being a little shady, but they are the world's largest asset management company. Personally, I think every giant corporation is shady, so I don't usually let that stop me from investing in something, but that's I'll let you guys decide for yourselves how you feel about any of that, or the ethics, or all of that. But just sticking to the facts here, looking at the stock, stock is close to a record high right now, so it's very high. They've got a forward P ratio of 24, which is pretty high for the kind of sector that they're in, because they're over 100% higher than the sector. But financials are also very strong. I mean, you're talking revenue growth of 18% this year and 10% next year as well. So that's pretty good growth, especially for that sector. And they even pay a very nice dividend of 1.8%. It's not too high, close to 2% there, but it's got some really nice growth metrics on it. So I actually do really like that dividend. It's probably a good stock to own long term, and if you're someone who doesn't like to pick and choose individual stocks, and maybe you like to stick to something like an ETF or a huge asset manager, then this can actually be a solid choice for you. It's just kind of a solid kind of long-term play. I think you'd probably be fine with BlackRock, but those type of things don't really interest me that much because I do like to pick and choose everything, and it's not really the sector that I usually invest in myself. But you're probably fine if you invest in them long term. Okay, now when looking at Chewy, I've actually always been a fan of Chewy, but I never owned the stock myself, and I'll explain why in just a second. But I kind of like them because they operate in 2 of the hottest markets in the entire world, and one of those is selling pet products, and the other is online retail. And those are 2 things that are never going away. I mean, when you talk about pets, I really get the feeling sometimes like people spend more money on pets than they do on humans. And when you look at online retail, that's obviously the trajectory we're headed towards. I think a lot of us are not big fans of that future of everything kind of going digital and online retail and all that stuff, but it's just the reality we live in. I think, we all know that online retail is only going to get bigger over time. So Chewy, being a company that sells pet products online, bodes very well for them. And of course, during the global health issue and the pepperoni lockdowns, people were buying a lot online, and that really helped Chewy out a lot. Unfortunately, though, it sent the stock skyrocketing. I mean, the stock went from like $20 a share to over $80 today, which is an increase of over 300%. And so now you're talking about a PE ratio that is over 900, which is obviously astronomical. But this isn't really a profitable company yet, depending on kind of how you look at it. So you'd probably want to look at their price to sales ratio more. And there it sits at 5, which actually isn't too bad because they do have, decent revenue growth. This year, you're talking about growth of probably another 30% and then another 20% next year as well. So it's an interesting one, and I do like them long term, and I like the business, but I think that the valuation is a little high, and actually the revenue growth right now isn't as high as maybe I would have expected it to be. It's pretty high, but there's other stocks, there's other companies that are growing at similar rates and actually are very profitable. I don't know. It's okay. I think it's an okay pick, but out of the 2 that we've talked about so far, them and BlackRock, I think I would actually prefer BlackRock myself because you actually get that really nice dividend. And then I'll just finish up here with Google. And I mean, what else do I really have to say anything about Google? Google is always a buy. It's a stock. Look, this is what I would say about Google. It's a core foundational stock. I don't own it myself, but that's only because I already own a bunch of core foundational stocks, and I don't need to own every core foundational stock. This is a misconception that people have, that they think that you have to own everything just because it's good. You don't have to own everything. But I own core stocks like Microsoft and Amazon and others, and I even have some Apple. I've got a lot of stuff. So, but I am going to actually own Google stock. I am going to own it. I know I keep saying that, but I am going to own Google stock. I will be an owner of Google stock because it is a phenomenal stock to own, whether you like them ethically or not, whatever, but just kind of fundamentally as a business, this is a business that is only going to get bigger over time, and they're already so incredibly dominant. And I think that this is what I would say about them. People usually don't buy Google because it's up too much. This is what I would say. Buy a small piece of it. If it goes down, you can buy more. And chances are that it's probably not even going to go down. But if it does go down, buy some more. If you're looking for a core foundational stock, because I think it totally fits the bill. You can never go wrong with Google. And I would say in any environment, you could buy it because as long as you're thinking long term, who cares? If you buy it at the very top and then the next day there's a stock market crash and it falls 40%, who cares? Double your position, triple it, buy a lot more, and then wait a few years. It'll come right back up. I mean, you really think that Google stock would crash and not come right back up and hit new all-time highs over the long term? I think you're being delusional if you think that, but that's just my opinion. So anyway, I hope you guys enjoyed today's video. It was certainly a lot of fun for me, and I look forward to getting more questions from you guys, and I'll pick and choose some to answer in future videos. But drop a like if you did enjoy it. Hope you're all doing well out there. I'll catch you in the next video. Take care, everybody. See ya. Bye-bye.